Hello everyone, hope you are doing great. In our today's discussion, in our today's lecture, we are going to solve question number 4, part A of March and June 2025 exam of SBR. We will only cover the exhibit 1 of this question and the requirement of part A of this question, as this pertains to two standards. One is IFRS 2 share based payment and the second is IAS 38 intangible assets. Part A is of 8 marks and major portion of this part A pertains to IAS 38 intangible asset. So we will first read the question, read the relevant exhibit, that is exhibit 1, and then discuss its solution and read the suggested answer. The question says, Reetah company prepared its financial statement using the IFRS accounting standard. The financial year is 31st December 2007. The following exhibits provided information relevant to the question. Exhibit 1, that is trademark. This provides information about a trademark purchased by the company. So there is a company named Reetah company who prepares its financial statements as per IFRS and the year end is 31st December. In the exhibit 1, it provides information about the purchase of some trademark by the company. If we read the requirement of part A, using exhibit 1 and in accordance with IFRS accounting standard, explain how to account for the purchase of the trademark on 1st January 2007 and discuss the issues to be considered when subsequently accounting for the trademark in the year ended 31st December 2007. So basically there are two sub-parts in the requirement A. First part requires us to explain how to account for the purchase of the trademark that was purchased on 1st January 2007. And the second part requires us to consider the issues when subsequently accounting for the trademark for the year ended 31st December 2007. Alright, so let's move towards exhibit 1. Exhibit 1 reads as, one of the Reetah's business activity is the manufacturing of food for human consumption. On 1st January 2007, Reetah purchased the trademark for a popular breakfast cereal. The consideration transferred by Reetah was 6 million of its own $1 equity shares with a fair value of $2 each. On 1st January 2007, a market expert valued the trademark at $10 million. So basically there is a company named Reetah whose business activity is the manufacturing of foods for human consumption. In the first para of the exhibit, it provides us information about some purchase of trademark for the breakfast cereal. And against the purchase of trademark, we have not paid any cash consideration. Instead, the company has issued 6 million of its own shares. The fair value of each share is $2, whereas the fair value, the market value of the trademark is $10 million. Alright. Under the standard IFRS 2 share-based payment, when we acquire goods and services from a counterparty and in consideration issues shares or share options of our own company, this transaction is considered as an equity settled share-based payment. This transaction is called as equity settled share-based payment. So here we are acquiring a trademark against the issuance of 6 million of our company's share. So this is basically an equity settled share-based payment transaction. Then as per IFRS 2, if we acquire goods and services from a counterparty who is not the employee of a company against some equity settled share-based payment, then this transaction would be measured at the fair value of goods and services acquired. Under the standard of IFRS 2, we have learned that when a company acquires goods and services from a counterparty who is not the employee of a company, in that case, that transaction, that equity settled share-based payment transaction would be measured at the fair value of goods and services. So here we are issuing 6 million shares of our company. The fair value of each share is $2 each. So the fair value of share is effectively $12 million. But the trademark that we are acquiring is having a fair value of $10 million. And obviously we are purchasing this trademark from some counterparty, from some independent third party. So we will recognize this transaction at $10 million each. We would debit the trademark at $10 million and we would credit the equity. But obviously we are issuing 6 million shares and the par value, the face value of share is $1. So we will be crediting the share capital with $6 million, and the remaining, the balancing $4 million will be credited in other component of equity, that is share premium. So the double entry would be trademark would be debited by $10 million, share capital would be credited by $6 million, and share premium would be credited by $4 million. Now this trademark is an intangible asset as per IAS 38, and IAS 38 defines intangible as an identifiable non-monetary asset without physical substance. Identifiable non-monetary asset without physical substance. So this trademark is basically an intangible asset that will be accounted for as per IAS 38. Alright. In the second para, this says management estimated that the trademark had an indefinite useful life when it was acquired because the trademark product was expected to generate net cash inflows indefinitely. So the management estimates that the trademark is having the indefinite useful life, as it is estimated that the product covered by the trademark will generate cash inflows for the indefinite period for the indefinite useful life. As per IAS 38, we amortize the intangible asset on systematic basis over the useful life. The intangible asset having the useful life would be amortized over the useful life. But if the intangible is estimated to generate cash inflows for the indefinite period, then such intangible asset would be considered as having the indefinite useful life. If the future cash flows of the intangible asset are estimated for an indefinite period of time, there is no foreseeable limit to the cash flows, then such an intangible would be considered as having an indefinite useful life. And in such case, there would be no amortization against such intangible. If the intangible is having an indefinite useful life, there will be no amortization against such intangible asset. But we need to do two things. One is we have to perform annual impairment testing, that every year we have to perform the impairment testing of that intangible having indefinite useful life, despite the fact that there is not any indicator of impairment. In case of intangible having indefinite useful life, whether there is any internal or external indicator of impairment or not, we will perform its impairment testing by comparing the carrying amount and the recoverable amount. And also we need to perform an annual assessment, we need to perform an annual review about the useful life of that intangible, that whether the useful life is still indefinite or it would have been converted from indefinite to definite. So we need to perform two things. One is impairment testing and the second is reassessment or review of the useful life. Alright. Then it says, however, a few months later, several discount supermarkets launched a similar product without breaching the trademark, and Reetah experienced an immediate 35% reduction in sales of the trademark product. Management estimates that the net cash inflows will stay at this lower level for the foreseeable future. However, due to the popularity and the recognizability of the trademark, management expects that the product will continue to generate these lower net cash inflows indefinitely. So in the second part of the second para, it says that there is a launch of several supermarket discounted product that has caused the reduction in our sales by 35%. Management estimates that net cash flows have declined at this lower level, but still the brand, the trademark is popular, it's recognized, so this will generate cash flows for the indefinite period in this situation as well. So obviously, if we are going to perform the assessment of the useful life, the facts, the quotients specifically says that cash flows will still to be generated for the indefinite period. So there is no change in the useful life, or there is no change in estimate about the useful life assessment, useful life estimate. So still no amortization would be recognized, no amortization would be charged. But obviously there needs to be an impairment testing, as this is intangible having indefinite useful life. There is a need for impairment testing as we have external indicator of impairment. Because of the competitor's discounted product, our sales have declined by 35%. So this is an external indicator of impairment. Even if there is no indicator of impairment, we would still perform the impairment testing, because this intangible is having the indefinite useful life. So we need to perform the impairment testing. by comparing the carrying amount of 10 million with the recoverable amount. We know what is recoverable amount. Recoverable amount is the higher of value in use or fair value less cost to sell. So we will first determine the value in use as the cash flows have decreased. So there are chances that value in use would have declined as well. We would determine the value in use, the fair value less cost to sell, compare it with each other, and the higher of both would be considered as recoverable amount. Then that recoverable amount would be compared with the carrying amount of the intangible asset. And if that recoverable amount is lower, is less than the carrying amount, we need to record the impairment. We need to recognize the impairment loss in our profit and loss account. So this is the whole scenario, and I guess while explaining this scenario, I have explained you what would be the accounting treatment, how to recognize the intangible asset initially, how to account for the intangible assets subsequently. So let's read its suggested solution. It says, according to IFRS 2 share-based payment, the purchase of trademark is an equity settled share-based payment because goods and services has been acquired in exchange for the company's own equity shares. Because this is an equity settled share-based payment, the company should measure the trademark and the corresponding increase in equity directly using the fair value of the trademark received. The fair value of the trademark was reliably measured at $10 million, so this is the amount at which transaction should be recognized. In accordance with IAS 38 intangible asset, trademark is an intangible because it is identifiable non-monetary asset having no physical substance. As such, intangible asset should be recognized at $10 million. A corresponding credit is posted to equity. Out of this 10 million, 6 million is recorded in share capital and the remaining 4 million as other component of equity, that is share premium. So the first part of the requirement that requires us to how to account for the purchase of intangible initially, this solution covers almost the same thing that we have discussed while explaining the question, while explaining the facts. In the second part of the solution, it says about the subsequent treatment. Intangible assets are amortized on systematic basis over their estimated useful life. However, intangible assets with an indefinite useful life are not amortized but are instead tested at least annually for the impairment. An intangible asset is assessed having an indefinite useful life when there is no foreseeable limit to the period over which the asset will generate future benefit for the entity. There should be an annual review to determine when an indefinite useful life, whether the indefinite useful life continues to be correct the assessment or not. So normally under IAS 38 we need to amortize the intangible asset over their useful life. But if the intangible is having indefinite useful life, then there would be no amortization and we need to perform the impairment testing, we need to perform the assessment of the useful life. An indefinite useful life means that there is no foreseeable limit for the period to which the intangible will generate the future cash inflows, so it is considered to having an indefinite useful life. Then it says, although the estimate of the future cash flows from the trademark have declined significantly by approximately 35% as our sales have declined by 35%, they are still expected to occur indefinitely. This means that there are no foreseeable limit to the period over which the trademark will generate future benefit for the company. The trademark therefore has an indefinite useful life and no amortization should be charged. So even though the cash flows have declined, the sales have declined by 35%, but still the management believes that it will generate cash flows indefinitely. So there is no change about the assessment, about the assessment of the useful life of the intangible. So accordingly, no amortization would be charged. At 31st December, an impairment review should be performed by comparing the $10 million carrying amount of the intangible with its recoverable amount. IAS 36 impairment of asset defines recoverable amount as the higher of fair value less cost of disposal and the value in use. And the reduction in net future cash flows will mean that there is a significant decline in the value in use. First, since this intangible is having an indefinite useful life. Secondly, there is an external indicator of impairment, so we need to perform the impairment testing. And how such impairment testing is performed? We need to determine the recoverable amount, which is the higher of fair value less cost of disposal and the value in use. The recoverable amount will be then compared with the carrying amount and if it is lower than the carrying amount, if it is less than the carrying amount, we need to recognize the impairment loss in profit and loss. Since there is decline in the future cash flows, so there are high chances that the value in use, that the recoverable amount of this trademark, of this intangible, would have been declined. So this is the suggested answer provided by the ACCA examiner. I hope I would have been able to explain this part and the solution to you very well. So let's keep this lecture here for now. Thank you for watching.